So the Feds are declaring that there's going to be a recession coming in 2023. So how does that affect us, and how do they know that a recession is coming? Now, everybody knows that we've been living through a bubble for the last 5 years. I think before pre-pandemic, we were already living in a bubble. Then the pandemic hit and that bubble increased, right? And we are at an all-time high for inflation. We haven't seen inflation like this since the 1980s. And we're set up for a recession, right? Or not. And so that's the big question. And one of the big things is the Federal Reserve is the one that prints money. The Federal Reserve is a institution that's non-governmental, and it's ran by our central banks. And so one of the things that you have to recognize when you're looking at the potential of a recession is what the Feds are actually looking at doing. So there's two primary things. And since the Federal Reserve is ran by the central banking system, one thing you got to look at is you got to look at the bank's earnings. And so if the bank's earnings are really good, the chances of us going into recession goes down. But if bank earnings start to get compromised, the chances of recession definitely goes up. Now, one of the big things that the banks, the Federal Reserve and the Feds are doing right now is they're raising interest rates, and central banks are trying to clear their balance sheets. They're selling down $9 trillion of securities on their balance sheets right now, and they want to do it at a rate of about $1 trillion a year. That's a big number. And so when we're looking at that, that's the banks trying to relieve their liability to make their earnings even stronger. Now, when interest rates go up, what the Feds are trying to do is they're trying to balance inflation, because we've had such hyperinflation over the last 2 years. What they're trying to do is they're trying to balance that out for our U.S. population in lieu of keeping the dollar bill from weakening worldwide. Because the more inflation happens, the more money that's printed, and the more our economics, as far as inflation goes up, our dollar bill gets weaker. And so to prevent the dollar bill from getting weaker and weaker and weaker, they'll raise interest rates. So the Feds are talking about raising interest rates as much as 50 basis points. So we may see interest rates rise as much as 3.5% in 2022 by the end of the year. That's a big number, being that interest rates were at 3.5%. If they go up, that means that if they go up 3.5%, that's double where they are now. So we'll be seeing interest rates at 7%. So for those of you guys who follow our content because of your real estate investors and you want real estate investment wisdom and knowledge, listen up. One of the big things when you're talking about 7% as far as interest rates and cap rates run parallel to each other. And most people do not realize this. So what I mean by that is that when cap rates go down as low as they have over the last 2 years, and for those of you guys who don't know what a cap rate is the capitalization rate of an asset. So take, for example, if you make 5% cap rate on a property that's $1 million, you're basically making 5% on your money if you paid off that asset cash. So if you went in and you paid 5% on a $1 million asset and you paid for it cash, your return on investment annually will be 5%. So the annual percentage rate when you go in and you get a mortgage and you finance something is very similar to the cap rate and the earnings of a property. Now, if earnings don't supersede interest rates, what ends up happening is somebody has to service that debt. So they have to run parallel with each other. The reasons the cap rates dropped from an 8% cap rate from 4 years ago all the way down to a 3%, 3.5% cap rate in the last year is because interest rates went down so extremely low. Now what's happened is interest rates are going to start rising. And so what happens in the market when interest rates start to rise is that this is how large assets go into bankruptcy. So for those of you guys who have been waiting, and you've been yourself clearing your balance sheets and freeing capital, this is a great time to do so because it's going to teeter-totter. we build out a lot of assets. And the reason we build out assets is because when cap rates go down really low, I get concerned because I sit back and go, okay, there's a threshold of diminishing return. And when that threshold goes down so much on cap rates, if interest rates rise, our ability to refinance that property goes down tremendously. So people that have walked into, let's say, partially value-added properties, and they paid 3.5–4% cap rates on these properties. Now they go in expecting to raise the value to 8%. They dump money into the asset, and then they want to do a cash out refinance at an A cap to pull it out. Now, when they pull that money back out, if they did a 3.5% interest rate, 4% interest rate, they're making money on the debt that they're actually getting on that asset. The problem is that now to do a cash out refinance, when cap rates rise, values drop. And so that's why for real estate, inflation is great. Inflation is a good thing. We want to see inflation. But the reason it's bad is because the average person, it markets them out of being renters and out of being able to purchase homes. So you have to find a balance. And inevitably, even though us as real estate investors love to see inflation because the values of our properties go up and typically cap rates drop, well, it's gonna hit us in a backlash. And the people that can sustain their assets during a recessionary time when interest rates are rising and they have the inability to refinance at a low interest rate, that the refi, when they refinance that value add property at an 8% interest rate or a 7% interest rate, and it's only a 3.5% cap rate, and even if they raise it to 7%, the value stays the same. They refinance, they get no money out, and all they're doing is refinancing the property, and they get zero of their capital back out of that asset. Now, the reason that's a problem is because a lot of times that revenue comes from investors. So if you're an investor investing as a limited partner in a syndication, you have to be extremely careful how you're looking at the numbers right now, just as careful as somebody buying an asset. Because if you went into it expecting to make a 4% cash on cash return, meaning that you put in $100,000 and you're expecting to make 4% on that with the hopes to make 8%, well, ladies and gentlemen, is that as the general partner, the primary on that syndication starts to go in and do the value add, if interest rates rise and values drop, their ability to get the appraised value that they're hoping to get with the value add diminishes, so their ability to refinance cash back out and be able to get a bit larger cash on cash return starts to diminish with their value add, meaning that your money will be tied up for a longer duration of time for a smaller percentage rate of cash on cash return. Also meaning that your internal rate of return, the money that you make when that asset is sold, will also go down because values will drop. Now, hold on, don't get too alarmed. The only people that lose under circumstances like this are people that can't hold their assets, because historically, real estate does go up over the course of time. If you look at real estate over the last 50 years, it averages 2 to 3% annually as far as appreciation. Now, there's an exception to that. Because real estate went up over 21% over the last 2 years, we sit back and we have a little bit of growth to absorb. And so we may see 1 year, maybe 2 years, possibly even 3 years, where asset values actually drop for a short time, plateau, and then they have a bell curve where they slowly start climbing. The good news is that over the course of time, if you can hold that asset for the long haul, you will win. Now, how does that affect us today? Well, here's what I got to tell people today. If you have liquidity and you've cleared your balance sheets exactly like the banks are doing, there's going to be a lot of inventory that's going to come to the market, because some of these people that I'm talking about that finance low and low cap rates, low interest rates, low cap rates, when they go out and they do a CapEx and they do value add and then they go in and refinance, they're either going to be forced to come to the table with more money to refinance that asset, and more times than not, they don't have that capital. So when they don't have that capital to refinance, they're stuck in that asset at a low interest rate, low cap rate, with the inability to push rents. Hence, they're forced to either sell that asset and lose their equity in it, which ego gets in the way. And a lot of times people go into what's called denial. Similar to an addict, in denial, that they have a problem, right? And hence, the problem being the fact that they cannot refinance out of that asset because the equity they once had is no longer there because cap rates have went up and values have went down. And so if they're in a position where they have to refinance or they have to sell, they can't because they don't have enough equity in that asset to refinance or sell because they don't have the capital to get out of that asset. So the bank lands up coming in, taking over that asset, and that's where people like you and I come in, buying distressed assets in times of recessionary periods, which is what we've been waiting for. Now, we don't want to see anybody get hurt by a recession, but inevitably, we didn't create it. So opportunities are made in historical times, being that one is going to happen. I've been talking about this since 2019, saying we're way overdue for a recession. We're way overdue for a market correction. Be careful on how you invest. Pay attention. I underwrite deals looking for problems. I look at deals going, why should I not buy this asset as opposed to why I should buy the asset? Because I want to look for all the problems in that asset, making sure that when I invest my money, I have an exit strategy. Now, if I go in, I'm looking for problems, and I find them, then at the end of it, I sit back and go, there's actually some profitability on this in spite of what's happening economically. And if at that point, things look good, I say, let's buy this. And that's how we've continued to grow and achieve what we've done over the last several years, even in an inflationary market point. Now, our buying power is going to flip. So what we'll do is, why would we build and put the effort of building in when our assets are going to flip? Now, we're still building. We can still get into these assets at such appreciated values and with so much equity that building still makes sense. But I will now, in about a year or 2 years from now, depending on how interest rate rises, how the Feds increase interest rates, we will start looking at value add properties again and distress assets that come onto the market, and you should too. Because it's not only going to happen on the large equity scale where we're going in and buying 100 units plus, it's going to happen on the individual single family house side as well, where people go in, they get over leveraged on a single family home, rents start to get compressed, they can't get the rental rates that they once were because now people can't afford them, and they know they're wise. Buyers are wise. They know that costs are dropping because interest rates are going up, so the rates of rentals go down, hence putting people in a position where they either need to refinance, sell, or get out of that investment asset. Now look, this is a great time for you to do what all the central banks are doing. They're proposing to clean their balance sheets, and you should clean your balance sheets and get ready to buy. This is going to be historically the best time to buy. You want to get wealthy? All it takes is one market correction for you to get wealthy. If you position yourself correctly, this could be one of the most advantageous times that you've seen historically. And so I'm telling you that right now, more than ever, you should clear your balance sheet, sell off some assets at premium values before interest rates rise, let somebody else get into those, and then bank that money for a short period of time and start underwriting deals, becoming familiar with real estate underwriting and the asset class that you want to invest in, because there's going to be more opportunity over the next 2 years than we've seen in the last 5. Ladies and gentlemen, is the recession really that bad, or is this an opportunity for you to thrive? We'll find out more as we move in and find out what the Feds do, what the central banks do. All I'm telling you is position yourself to win. Keep following our content, pound that like button, and for more information, as the banks and the Federal Reserve start to make changes and modifications to what we're doing economically, I will continue to bring you updates. Click and subscribe so you get those notifications, pound that like button, and I'll see you next time.